Well, here's another winner of the decade. HCL Technologies stock, as I just said, has seen a 15 times rally in the last decade, 2010 to 2020, and that's why it's our winner of the decade. HCL Tech was the first to catch on the infra management services wave, and then it went on to build scale and benefit from it, and that differentiated this company from its peers. Now from the next tech wave, which is, we are told, driven by cloud. Here, everyone is building scale and expertise. So, to give a sense of what HCL Tech will do different, what's their strategy, we're joined by Prateek Aggarwal, Chief Financial Officer, HCL Technologies. Prateek, good morning and thank you very much for joining us. That really is the first question. Everyone's on to cloud, everyone's building scale over there. So, first, of course, congratulations for being an outstanding winner of the decade gone by. But what will you do different here on?
Good morning, Lata, and thank you for having me and HCL on the show. We are delighted to be part of your Wealth Creator series. And like you said, apart from, the stock performance itself, I think, the revenue growth over 10 years, FY10 to FY20, has been a compounded close to 15%, 14.5%. To be precise in dollar terms, and if you look at it in the rupee terms, it will be closer to 20%. So also the EBITDA and EBIT and net income itself is almost 20%, 19.7%. And the best news is on the cash flows actually. The operating cash flow is also 20% up CAGR and free cash flow at 23.5%. So those are the numbers which have really driven the stock performance in the last 2 years itself, calendar year 19 and calendar 20 so far. The stock is up 90%. That is driven by a return on equity, which is close to 25% over the last 3 years as well. So, all in all, it's been a very satisfying last 10 years, and obviously it's the 150,000 plus HCLites to thank for it. I think to your comment about infrastructure management services, that is one out of the three pioneering contributions of HCL to the industry. The very first one was actually ER&D, or ERS as we call it, engineering and R&D services. That's the original DNA of the company, starting off from the days of being the first computers in the company and so on and so forth. And the third one is actually what we started about 4.5 years back, which is the products and platforms. Okay. So apart from the cloud, which is very much in the discussions today, it is the software products, which is even bigger opportunity actually, because that is what digitization is all
Mr.
about.
Agarwal, actually I wanted to get a sense on that. Good morning and thank you for joining us. What are your clients telling you in terms of tech spends compared to what it was, say, about 3-4 months ago? Have client spends gone up? And if you can break that up for us between legacy projects and digital projects, do you see more money go into new digital projects, thereby some cost cutting in the legacy projects?
So the clients are, coming out and, there is, I mean, even at the end of September, when we announced our results, we said very clearly that the pipeline is at its highest ever. And in fact, in this quarter, it has gone up even more. So, pipelines are bursting at the seams, so to say. And that tells you that, whether it is the cloud migration, whether it is digitization projects, or whether it is typical consolidation or cost-cutting kind of projects, either which way, both are seeing, as the world comes out of the COVID pandemic and preparing to sort of get vaccinated and so on, so forth, the impetus to spend more on IT is only going up, which is the longest term trend as well. I mean, in our personal lives also, we can see that each and everything that we do is becoming more and more IT enabled.
Your margins have historically trailed your peers like in Infosys and TCS. Now that we are in the next phase of a tech upgrade cycle or growth cycle, do you think you will be able to catch up on margins? Your current margins are hovering around the 20-21% band. Can you move it up to say a 24-25% over the next decade?
So margins, there are various ways to look at margins. I prefer to look at EBITDA rather than EBIT. And if you look at EBITDA, we are pretty close to some of our larger peers, much closer than the comparison on EBIT seems like. And the reason for that is, the reason for looking at EBITDA rather than EBIT is because EBITDA is much closer in terms of cash flows. And as you know, and as all capital market participants know, the cash flow is the ultimate metric that is important to the shareholders and to the investing public at large. So EBITDA-wise, I don't see us as behind anybody materially.
Okay. Well, Mr. Agarwal, I want to take on that sentence you said, the deal pipeline is bursting at its seams. I mean, this is the phrase of the day, the phrase of the month for your sector. Your deal pipeline was 20% higher in Q2 than Q1. What will you say of Q3? Is it much higher than 20%?
No, I don't want to put numbers in the middle of the quarter. We'll come back in middle of January to announce our results. I leave it there for now. But our pipeline at the end of Q1 was actually 40% higher. At the end of Q2 was around that 20% higher. So yes, it has meaningfully gone up. I'll prefer not to put a number to it right now.
Sir, if you could throw some light on the cloud opportunity, how many of your clients have transitioned to cloud? What are the current deal sizes in cloud, the tenure, and what is the change expected when we talk about this whole wave of cloud adoption?
So, see, the cloud adoption is not a one-time journey. Rather, it's a journey over a period of years potentially. For, let's say, a Fortune 500 or Global 2000 kind of a client, typically the cloud adoption would tend to be very low percentage in percentage terms. So let's say if 100 is their total workload on private or on-premise type of data centers, typically the public cloud percentage would be low. It would be in single digits or something like that. It is when you go down to the enterprise level or the mid-market or even SMB, that is where the percentages go up. In most customers, it's typically never 0-1 kind of a scenario, except in a very few just started up kind of companies where it might be 100% on cloud. But typically it is always a hybrid cloud, and the larger the customer, the percentage of the workload on cloud is typically even now very small. And that is why we think it is, at least 3 to 5 years journey for most of these customers, and it's potentially never going to be a 0-1 scenario.
Okay. Today, investors are most pleased when companies return wealth to shareholders, right? And you have indicated that there is further scope to increase the payout ratio from 30 to 35% of profits currently, and that the board will take a call on either a special dividend or a buyback in Q4 of this year. Just trying to understand how much can the company return to shareholders over the next, say, 3 to 6 quarters?
So I don't think we are sort of talking about either a buyback or a special dividend. We have already increased our regular quarterly dividend to 4 rupees per quarter per share, which is on a double the share numbers because of our 1:1 bonus last year in December. So that is where we are, and that does translate to that 30 to 35% payout. But I look at it as an investor myself, right? As a personal investments, what do you prefer, right? Is it the capital gains that you make on the share that on a post-tax basis as an investor is much more valuable? Because earlier there was 0% long-term capital gains on share capital gains. Now, of course, there is a 10%, but that 10% is still much lower compared to what a company or a shareholder ends up paying on either a dividend or a buyback in terms of tax. So from the investor perspective, from a shareholder perspective, I personally believe that the share capital gain is more beneficial rather than just doling out more and more in terms of dividends or buybacks, which is taxed at more than double the percentage. So, I mean, the 90% increase in our share price in the last 2 calendar years is, suffers a 9% tax rather than the 20% tax that plus the cess and this and that, which the
got
and buyback.
Yeah, got that, Mr. Agarwal. Got that, Mr. Agarwal. We are being told that we are overstaying on the show. So a very quick last question. Going by the way you are describing the deal pipeline and the use of technology and adoption of cloud, can you say that the next 2 or 3 years are going to be qualitatively superior to the past 2-3 years?
Absolutely. I think, the demand that we are seeing post-COVID, is materially different from what we saw in the last 2-3 years. And I think for the next 2-3 years, I'm pretty confident that, we'll see better growth rather than the growth that we saw in the last 2-3.
Yes, the equity investors are already pricing that in and giving pricier valuations, and they're quite confident that EPS growth will follow. Thank you very much, Prateek Aggarwal, for joining us, and here's wishing a great 2021 to everyone at HCL Tech.
Thank you. Wish you a happy new year and prosperous new year.